Welcome back to Investing Talk Podcast. Today we're tackling a question that's likely on many of your minds, especially if you're keeping an eye on the travel sector. Is American Airlines a good time to buy now? We've gathered a stack of recent reports, financial filings, and market insights specifically for you to help unpack this. We'll look at everything from their latest financial health to market sentiment and what might be coming next. Before we jump in, if you find this kind of detailed analysis valuable, please remember to subscribe, like, and leave a comment. Your support really helps us keep these explorations coming. And if there's a specific company you'd like us to look into, just let us know in the comments below, or maybe consider buying us a coffee to support the show.
Indeed. American Airlines is a fascinating case study right now. We'll be synthesizing information from their Q1 and Q2 2025 results, their 2024 10K, and various market analyses to give you a comprehensive picture. Our mission here is really to break down the complexities and highlight the most important insights so you can feel truly informed about this major airline.
All right, let's unpack this then. We'll start by looking at the company's foundational strength, their financials, and their competitive standing. When we look at American Airlines' recent revenue and earnings performance, the big takeaway from Q2 2025, wow, they didn't just see a recovery, they actually outpaced expectations.
Yeah.
Their revenue hit a record USD 14.4 billion.
That's a huge number.
It really is. And what's remarkable here is how strategically they achieved this. It seems driven by a stronger than expected rebound in leisure travel and, crucially, really high demand for premium cabins.
Especially on those long-haul international routes, right? That's where the big money often is.
Exactly. It signals a targeted strength, not just a general market lift. And going back a quarter, Q1 2025 revenue was USD 12.6 billion. That was up slightly from Q1 2024, about 0.7% on unit revenue.
Yeah, with stable international unit revenue and that continued growth in premium and loyalty segments, they keep highlighting those.
They do. And they've reported industry-leading year-over-year improvements in passenger unit revenue for 4 straight quarters now. That says something about execution.
It certainly does. They also seem pretty confident about getting back to historical indirect channel revenue shares and hitting their long-term growth targets.
So the top line looks pretty robust, you'd say?
Robust, yes. But what's fascinating here is that while we see this strong top-line growth, the underlying financial health, well, it presents a much more complex picture. American Airlines is navigating this recovery with, let's call it a co-pilot, of over USD 40 billion in total debt. That's as of their latest 2024 10K.
40 billion. That's significant.
It is. It's one of the highest among major U.S. airlines. And this isn't just a number on a page. It means a big chunk of their impressive operating cash flow gets eaten up immediately.
The debt service, right? And CapEx.
Exactly. Debt service and the ongoing capital expenditures needed for fleet upgrades. They're taking steps, cost management, refinancing initiatives. But it raises a really important question. How does a company balance that kind of top-line growth with such substantial financial obligations?
That is the key question, isn't it? Because while that USD 40 billion debt is definitely a heavy lift, you also see them making strong strides competitively. They've got the largest network in North America. They're actively strengthening indirect channels, the loyalty programs. That's crucial for repeat business, higher margins.
Absolutely. And they are showing that positive growth in premium and international travel, even outperforming some peers on unit revenue there.
So is it a case of just trying to grow their way out of debt? Or is there something more strategic going on to manage both growth and that debt mountain?
It seems like a multi-pronged approach. The growth in premium and international is definitely strategic. Higher yields boost revenue directly. But at the same time, they are managing costs, refinancing where possible. The challenge is that high debt plus intense competition from, Delta United, it's a constant headwind.
Right.
And while the fleet refresh and marketing efforts are good for customer experience, attracting those premium flyers...
It costs money, ongoing capital intensity.
Precisely. It constantly draws on cash flow. So a lot of that hard-earned revenue has somewhere to go before it really benefits shareholders.
Okay, so we've got this picture. Strong revenue, good market position, but under this big shadow of debt. What does the market actually make of all this? Let's look at the valuation ratios. These help us see how the market values the company compared to the industry. For instance, their PE ratio, price to earnings, looking back 12 months, is around 12.5.
Which is a slight premium to the industry average, about 11.2.
Right. But then look at the PS ratio, price to sales. It's around 0.25 for American. The industry average is like 0.8. That's a deep discount.
A very deep discount. And PB, price to book, is similar, about 1.2 versus the industry's 1.6, so below average there too.
It really is a mixed bag, isn't it? What do you make of these mixed signals?
Well, they're very telling, actually. If we connect this back to the bigger picture, these low valuation ratios, especially PS and PB, they typically reflect that high leverage we talked about,
Mm.
and just general market caution around airline stocks. The market's basically saying, yeah, we see the revenue recovery, but we're heavily discounting it because of the risks.
Primarily the debt risk.
Primarily the debt, yeah, and the cyclical nature of the business. When you look at valuation models like discounted cash flow or relative valuation, they don't show a ton of near-term upside because of that. Shares seem to be trading maybe slightly below intrinsic value based on modest future cash flow estimates, but they're super sensitive to macro conditions.
So the market gets the revenue story, but it's hedging its bets because of the debt and the industry itself.
Exactly. It's weighing the good against the bad, and the bad, or maybe the risky, is weighing quite heavily.
That makes sense. A very clear picture of market sentiment there. Now let's shift gears again. Let's look at the pulse of the market through technical analysis, price movements, indicators. American Airlines has recently been trading, mid-August to early September 2025 in a range between roughly USD 12.50 and 14.50. It closed at USD 13.39 on September 2nd. For anyone watching the charts, key support levels look to be around USD 12.0 to 12.50. That's where buyers might step in.
And resistance, where sellers might emerge, seems to be up around USD 14.50 to 15.00.
Okay, what about the trend indicators? What are they telling us?
Well, they kind of reinforce that range-bound picture. The 50-day simple moving average, your shorter-term trend guide, is near USD 13.0. It's showing a slight upward trend, which is, mildly positive short-term.
Okay.
But the 200-day SMA, the longer-term view, is pretty flat around USD 14.00. That suggests more sideways trading than a strong directional move.
And the momentum, RSI, MATI.
RSI, the relative strength index, is at 47, right in the neutral zone. Not oversold, not overbought. And MACD, moving average convergence divergence, has a really narrow spread. That signals pretty limited short-term momentum either way.
So basically holding steady.
Yeah, volatility is a bit elevated, which is normal for airlines, but it has been declining recently. So the technicals are painting a picture of consolidation, maybe slight short-term positive bias, but no major breakout imminent.
So what does this all mean for someone watching the charts? It sounds like the stock is currently in a bit of a holding pattern, not making dramatic moves, slight positive short-term signals, but the longer trend is flat. Now let's bring everyone up to speed on what's been happening recently. Specific news, general sentiment. We mentioned Q2's record revenues, the positive outlook on premium and indirect channels.
Right, and Q1 also showed that stable unit revenue, ongoing improvements in loyalty and network. Operationally, they've been busy. Looking beyond the numbers, their operational story over the last 3 months is really one of aggressive expansion and customer-focused stuff.
How's the analyst sentiment? Still mixed.
Still quite mixed, yeah. Mostly hold ratings, some underperform, mainly citing sector risk and, of course, the debt.
Insider activity. Major buys or sells.
Net neutral recently. No significant insider buying or selling last quarter, which, could suggest management thinks the current price is about fair.
And social media buzz. Still cautious.
Generally cautious, yeah. Lots of focus on macro uncertainty, fuel costs, operating pressures, that kind of thing.
Okay, but you mentioned operational strides. What specifically have they been doing?
Well, some interesting milestones. In September, just recently, they hit a big fleet expansion marker. Took delivery of their 1,000th mainline aircraft, a Boeing 787-9.
And that one includes the new flagship suite premium offerings, right?
Exactly, tying into that premium focus. They also launched a new flagship lounge in Philadelphia, again, targeting those higher value travelers.
And here's where it gets really interesting, I think. In August, they were testing that new tech at Dallas-Fort Worth, the one to help connecting passengers avoid missed flights.
Yeah, that's a smart move for customer experience. Plans to expand it too.
And they also implemented longer domestic boarding times over the summer, trying to streamline things, reduce delays during that peak season. Makes the whole airport experience a bit less frantic, hopefully.
And back in July, they really pushed the network expansion. Flight volume up nearly 5% versus 2024 for the summer. Departures from Chicago O'Hare jumped 20%.
Wow, 20% from O'Hare.
Yeah, supporting record passenger numbers. Plus, they confirmed new transatlantic routes like Chicago to Madrid direct, expanded capacity to Tokyo, leveraging codeshare partnerships there for better access to East Asia.
So it sounds like a really aggressive operational push. Network expansion, service upgrades. Feels like they're confident in capturing that recovering travel market,
Mm.
especially the higher yield parts.
That seems to be the strategy. Focus on the profitable routes and premium service while managing the operational challenges.
Okay, with all that context, operational push, financial pressures, market caution stare, let's look forward.
Yeah.
What's coming up? What catalyst could move the stock? Short term, the big one is always earnings. Q3 2025 report is scheduled for late October. That'll be key.
Absolutely.
And the fleet upgrades are ongoing through 2025, with some key deliveries expected by Q4. Longer term.
Longer term, that exclusive City Advantage credit card partnership launches in 2026. That's expected to be a significant driver for loyalty program revenue.
Loyalty is huge for airlines.
Huge. Also, keep an eye on potential industry consolidation or restructuring. It's always a possibility in the airline sector.
And the usual macro suspects: fuel prices, travel demand trends, labor negotiations, regulations, FAA stuff, international slots.
Always factors. But to get even more specific for you, looking at just the next 3 months, investor attention is going to be laser focused on that Q3 earnings release. That's September 18th. We'll see the impact of summer travel, fleet additions, those operational initiatives. Analysts will be digging into unit revenues, margins.
What else is on the calendar?
October 1st, you've got ETF quarterly rebalancing. October 15th, the September-October traffic report comes out. November 10th, watch for institutional investor buys data. And then December 1st, we'll start seeing the Q4 2025 earnings previews.
So Q3 results and Q4 guidance will be critical.
Absolutely. The market will scrutinize revenue guidance, cost controls, and holiday travel demand. Booking trends, those are major variables for the Q4 outlook right now.
Okay, moving from confirmed events to, well, let's call them whispers on the street. Rumors, speculative catalysts.
Yeah,
Unconfirmed, but they can influence sentiment, right?
definitely. These things float around.
One is about fleet renewal acceleration. Industry chatter suggests maybe more wide-body orders coming, leveraging their scale to refresh older planes.
That's out there. Makes sense strategically if they can manage the capex.
Another is international codeshare expansion. Speculation about new partnerships, maybe deeper alliances, especially thinking Asia, Middle East, could boost global connectivity, fill more seats.
Plausible alliances are key in this business.
Then there are rumors about corporate travel maybe picking up faster than expected in late 2025. That would obviously help the premium segment revenues.
That would be a significant positive surprise if it happened.
And here's an interesting one: dividend reinstatement talks. Some reports suggest the board might consider bringing back dividends or other shareholder returns given the improved cash flow.
Ooh, that's always a popular rumor. Would certainly grab investor attention.
These are definitely intriguing possibilities,
Mhm.
especially the dividend idea after such a long break for the whole sector. But like you said, whispers, no guarantees. Now, we have to cover the flip side. As with any investment, understanding the risks is absolutely crucial. What are the big ones here?
Absolutely critical. For American Airlines specifically, the number one risk factor is that high leverage. Over USD 40 billion in long-term debt. That means substantial annual interest expense. It poses refinancing risk, liquidity risk. It really underpins so much of the discussion.
It really does.
And it leads to that question. Can the revenue growth truly offset this massive debt burden and its costs, especially if the economy turns?
Right. What else specific to the company?
Well, cyclical earnings. Airlines are notoriously sensitive to demand shocks, economic downturns, even major accidents or incidents. It's just the nature of the beast. And then there's the fleet and capex risk we touched on. They have to spend money on new planes to stay competitive, but that constantly strains free cash flow.
So even when revenue is good, a lot of it is already spoken for.
Pretty much. And beyond company specifics, you've got the broader market and sector risks.
Fuel prices always loom large.
Huge factor. Fuel price swings can kill profitability fast. Add weather disruptions, geopolitical events shutting down airspace, intense competition.
Regulatory pressures too, right?
Yeah.
FAA, international travel rules, pilot shortages.
All ongoing concerns. Pilot shortages in particular have been a persistent headache for the industry. These sector-wide risks add another layer of uncertainty.
Okay, we have covered a tremendous amount of ground today. Looked at American from, well, pretty much every angle. Let's try and bring it all together for you. Our final investment thesis summary. Our overall rating for American Airlines, based on everything we've discussed, comes in at 4 out of 10.
A 4 out of 10.
Yeah. And the rationale is this. American Airlines clearly shows strong revenue recovery. Their competitive position is solid, especially with that focus on premium and international. But the high debt levels are a major drag. The industry's cyclical nature is undeniable. and analyst sentiment is pretty muted, reflecting those concerns.
So the valuation looks cheap compared to peers.
But it's arguably justified by the above-average risk profile and what currently look like fairly modest free cash flow prospects after debt and capex.
So what does this all mean for you as a potential investor? It means American Airlines presents a complex picture. It's not simple. You've got positive momentum in operations, good revenue growth, but that significant debt and the industry's inherent ups and downs are undeniable headwinds.
A classic risk-reward scenario, then.
Very much so. Heavily influenced by the broader economy and, crucially, by the company's own success in actually reducing that debt load over time. It's not a straightforward buy or sell call at all.
It really highlights how even with strong operational improvements and a clear strategy, that underlying financial structure and the market environment are just so crucial. It's a constant balancing act for them. We've explored American Airlines from their impressive Q2 revenues and fleet modernization efforts all the way to that significant debt load and the cautious outlook from analysts. We really hope this exploration gives you a much clearer picture of whether American Airlines might fit into your own investment strategy right now.
Indeed. And always remember, knowledge is most valuable when you understand it and can apply it. Think about how these factors align with your personal risk tolerance, your investment goals. The airline sector is incredibly dynamic. Staying informed is truly your best tool.
So, as you ponder American Airlines, here's a final thought for you to mull over. Given the company's clear focus on premium travel and those loyalty programs as key growth drivers, how might a sustained shift in corporate travel patterns, whether it's a strong recovery or a continued slump, ultimately reshape Americans' long-term profitability and, importantly, its ability to finally tackle that formidable debt mountain? Thank you for joining us on Investing Talk. Don't forget to subscribe, like, and please leave your thoughts in the comments. We genuinely love hearing from you. Until next time, stay curious and keep learning.